The following video will go through how to complete exercise 11.14 from the textbook, how to complete a cash flow statement for Peter Macbeth. The first step is to record all cash flows from operating activities, which will be the first heading, cash flows from operating activities. And you want to bold and italics that one. Okay, so as you know, inflows are recorded first. If you look at your instructions, the first one is your receipts from customers. So you can pop all of that straight in. If we go over to our income statement, we can see that our sales for the year were 21,500. And if you look at the additional information down the bottom, it says that all sales were on credit. What that means is we need to reconstruct accounts payable in our general ledger. So your account name will be accounts receivable. We'll put in the date as the 1st of July 2009. Okay, so what do we know? We know our opening balance, which we can get from, you put in an equal sign and go over to your balance sheet, it'll be the closing balance for the previous year. So that's 2350, okay, which is a debit balance. What else do we know? We know that there were credit sales made during the year, so we can record those in from the income statement, 21,500. Add those together because they're both debits. Right. If we have a look at our income statement, we also have a bad debt expense for $160. So if we go back here, we can record our bad debts, which will reduce the balance of accounts receivable because that money will never be repaid to us. So we can pop that figure straight in, bad debts. And then we know that's our new balance. Finally, we know our closing balance for the current year. So if you go to your balance sheet, pick up this accounts receivable figure, you know that that is $1,660. In order to get to that point, it's reduced from our last balance, 23,000, down to 1,600. So we can find out how much we actually received into our bank account, which is $22,030. This is the figure that you need to record in your cash flow statement as receipts from customers. So we can put in an equal sign, refer back to our general ledger, and pick up that figure. I just highlight it so it's very obvious which figure I need. Okay, so now we're on to step B within the operating activities. So we're looking for interest and dividends received. So if we go into our income statement and look for interest revenue, or dividend revenue would also be up in this other revenue section. So we can see that interest revenue existed. We're going to check the balance sheet in case there's any unearned interest revenue in liabilities, which there is not. So we know that we can put that figure straight in here. So we'll put in our title, interest received, okay, which will be equal to that figure on the balance sheet, which is $350. Sorry, I picked up the wrong one. 1200. Sorry. Oops. On there. 1250. Okay. And that is all our inflows because we don't have any other revenue. It's just that single interest revenue there. If there had been commission revenue, you would have put that into another section. Down here, you'd have other. So now we can do our outflows. So the first one we'll look for is payments to suppliers. Okay, so we can pop that in as our title, I should say. Now we need to go into the income statement. To find this amount. So we've got cost of goods sold here. It says down the bottom though that purchases were on credit. So if you see that purchases are on credit, it means that you need to record in your general ledger, you need to reconstruct your accounts payable account. In order to reconstruct accounts payable, you need to know your inventory figure. This also being on credit means that we have to reconstruct that one as well. And we're actually going to do that first because once we have the figure for inventory, we can then easily calculate accounts payable. So the first thing we know about inventory is the starting balance. So if we go to our balance sheet, we'll find that. In inventories control, closing balance from last year will be the opening balance for this year. So we can put that in. The next step here is that we know what our cost of goods sold was. Cost of goods sold. So I've left a gap because in that gap we're going to record how much we actually received. How much was actually recorded as accounts payable. So in our cost of goods sold, we will reduce that amount from the income statement, which is 9,800, which will lead us to find our closing balance, which is here from the balance sheet for the current year. So inventory control, 950. So if we work our way back up here, we know that to get the balance before, it has to be the 950 plus 9,800. Okay, and then we see that we jumped from 3,100 to this 10,000. So this is the amount of accounts payable. Okay, so we'll say equals the 10,000 minus the 3,100 will give us that figure. So 7,650. So we'll just highlight that one and go back up to our accounts payable. So the first thing we know about accounts payable is the opening balance from the the balance sheet. Okay, so if we go over to our balance sheet and find accounts payable from last year, it's our opening balance for this year, 3,400. Being a liability that has a credit nature, we can pop that in. Okay, so the next thing we know, which we found out from doing our inventory control, is that inventory was 7,650. So we know that if it's a debit down here, it's going to be a credit up here. Remember how everything has to equal? Being a credit, we add those two together, which gives us a new balance. Now finally, we know what our closing balance is. So that means that to get to our closing balance, we have to calculate how much is actually paid out of the bank. So the closing balance for accounts payable was 4,980. So within your debit side of the bank, so we've got a credit balance, we need to reduce it, so we'll debit it, say equals our last balance with our new balance, $6,070. Still credit balance there. Okay, and this is the figure that we need to pop into our cash flow statement. So if you remember, we've got to show these as negative, so just put in equals negative, go back to our general ledger and pick up that highlighted figure. Straight in like that. Right, the next one is payments to employers and employees. So this one may be very straightforward. It might just be as simple as going to the income statement, finding the figure for wages, and then popping it in. What you need to be careful though is whether there's anything on the balance sheet. So if you've got an accrued expense for wages, you have to reconstruct the general ledger to find out how much was actually paid out in cash. So if we go to our general ledger, stick in wages, and then record. So this is the one where we have to work backwards. So we know what we put into our profit and loss summary account or income statement. To close off the account. So that's the figure straight from the income statement for wages and salaries. So that's what we used to close off the account. Oops. Okay. So if we then work backwards, we know that we accrued some wages, so we had an accrued expense. Now, accrued expenses, you always debit the expense account when you accrue those in. So what that does is it increases the value. So we owe that money, so we can record it. So we go and pick up the figure. So it's going to go into the debit column. So at this point, we know we've got 6,000. To close it off, we had 8,700. So we know that that was our balance once we recorded that 6,000. Okay. Which means we can figure out how much was actually paid in wages throughout the year, which will be that 8,700 minus the $600. So 8,100 is our figure. We just need to record that. So that we have that finalized. So if you go over to your cash flow statement, you can put in equals negative, and then go back to the general ledger and pick that figure up. Okay. Now, the next part is our payments of interest or dividend expenses. So payments of interest. In this case, we didn't have any dividends, so I'll just call it interest. If I go over to the income statement, I can pick up that 350 expense. No, I can't. If we go to the balance sheet and have a look, we'll see accrued expenses interest $200. So we need to reconstruct this as well. In the same process as we did for wages, we'll work backwards. So we know how much we close the account off with, profit and loss summary. Go to the credit, because to close it to nil, we had to credit the account. Pick up that 350. That's our closing balance of 0. We know what the accrued expense was. Because that's sitting straight on the balance sheet, we can record that there, $200, which can give us an indication of what the bank was originally. So this would have been 350, and then our balance would be that minus that. 200.